Welcome to episode 27 of the Cashflow Connections podcast. Our topic for today is it possible to time the real estate market? You may have heard people say that timing markets is a fool's errand, and you could even make the case that failed attempts at timing markets have resulted in a significant amount of the devastation which has taken place in all of U.S. real estate history. However, regardless of whether or not you want to believe it, particularly in volatile markets, market timing can mean everything in the investment life cycle of an opportunity. So we're going to talk about it all today. We're going to talk about what 5 key indicators our guest uses in his market timing model. We're going to talk about how long you have to sell when the market timing model gives you a sell reading, the critical difference between market momentum and market buy-sell signals. So for example, just because a market has momentum doesn't necessarily mean it's a good time to buy in that particular market. And kind of along the same lines of thinking, are there any bubble markets out there where prices are significantly inflated? And is it really appropriate to consider selling in those markets? We're also going to talk about some potential weaknesses in the model and whether or not false readings is something that is part of this whole market timing strategy. Our guest is really one of a kind. He has been around the block. He has lived, seen, breathed real estate for almost 50 years. When it comes to real estate market timing, he's absolutely one of the best out there. There's just no question about that, in my opinion. So it's a real honor to have him on the program. He also has just about more energy than anyone I have talked to on the show. And I have a feeling that he can bench press more than me, despite the fact that he's 70. And I don't really know if I'm joking about that. So I'll have to follow up with him and let you know. Anyway, it's a really special episode. So let's go ahead and get right to it. How's it going, everyone? Our guest for today is Robert Campbell, who is the author of the book Timing the Real Estate Market, as well as the Campbell Real Estate Timing Letter, both of which have been instrumental in the decision-making processes of thousands of investors in the U.S. His timing strategy, which accurately predicted the crash in 2007, has been taught at the graduate level to students interested in real estate, which he's been involved in for more than 46 years. He has bought and sold over 40 rental properties and has developed over 50 homes and apartment buildings in that time. He has an MBA from the Real Estate Finance School. He has a BA in economics and an MBA in real estate finance from San Diego State University. So that short bio doesn't remotely do justice for the type of content we're going to get into and the intellectual capacity on this program today. So Robert, I really can't thank you enough. Thanks again.
Thank you for having me on, Hunter. That's quite an impressive introduction you made. I hope I can meet up to your standards.
Well, I have a lot of respect for you, and I'm really looking forward to getting your perspective on things because it's a really crazy time. It's a really interesting time in the market for a lot of reasons. And, I'm really interested to hear your perspective on some particular markets in particular. Before we jump into those details, though, let's take a step back and let's talk about your background and your introduction to real estate in the first place. How did you get interested in the space, and how did you end up focusing really on timing itself?
How I got interested in real estate was the fact that I'm the son of a home builder. He built homes for 60 years, and spec building and custom building for people for over 60 years. And I like to tell people, Hunter, that I was born on a building site, and that isn't too far from the truth. So I grew up in that business, and I learned how to love it. I love the outdoors, the physical aspect of it. And I decided, after high school, I went on to UCLA and got a degree in economics. And then, but I've always had a strong interest in the real estate aspect. And I first started investing in the stock market. And what got me into real estate timing was this. And this is 100% true, that I started playing the stock market. I always had a few bucks. I always worked hard, made money, invested it. And I said, how do you make money in the stock market? And he goes, you buy low and sell high. And I said, how do you do that? And he goes, that's what everybody wants to know.
Right.
And at that time, I've had a fascination with market timing, with having an edge in the market, Hunter, as far as when to buy, when to sell, because if you really want to be successful as an investor, you have to have an edge. I mean, it just goes without saying. All businesses, successful businesses that have endured time, and investors, they all have some kind of edge that gives them an advantage. And in many respects, it's no different than counting cards in blackjack, except with respect to timing real estate markets. I think my edge is significantly higher than the edge that Ed Thorpe, the mathematician, developed. However, you can still beat the house. You can still take the casino's money with any kind of an edge. So that's my fascination with it.
Very interesting. And obviously there's a lot of different ways to make money in real estate. And you frequently hear that in other asset classes in particular, something like stocks, for example, which I know that you're interested in as well, frequently hear people say, look, as long as you are adding value, that's the way to make money. But timing the real estate market is so complicated, so challenging, you might as well be focusing on other things. What is kind of your response to that in terms of timing the market versus focusing on, I guess, a value add type of strategy?
Well, I like both strategies. First off, don't think one is exclusive of another,
Sure.
because market timing, by definition, Hunter, implies you buy when there's value in the market, and those times, of course, are when prices are low versus high, and that, of course, is the Warren Buffett strategy, along with a lot of other successful people. That they always buy whatever they like. They like asset prices when they're low, because if you buy when asset prices are low, that means future returns are going to be high. When you buy when asset prices are high, future returns are going to be low. So that's the market timing part. Is knowing when to buy when you're buying high value, so that your future returns are going to be the greatest. And to comment on your question that it's incredibly hard, I'm probably, underestimate the skills required, of course, but that the basis of everything I do, and my timing model is about 85% accurate over the last 40 years. So, if you just follow these key indicators, these 5 key indicators that I lay out, that, anybody can do it. Just nobody does it. Nobody takes the time to do it. So I think the model following the indicators is about, 75% of becoming a high profit investor. And the other 25%, of course, is experience and having the brains and the patience to follow your signals, all those kind of things. So it's challenging, but it's not as hard as you seem to be making it out to be.
Yeah, that makes sense. And I think a lot of it has to do with the fact that when the indicators are laid out, which I'm sure we'll jump into in just a second, at the end of the day, people want so badly not to pay attention to them. They want not to listen to the data. And that's what really makes timing the market hard, is the sentiment, the consumer sentiment of the market is, it doesn't matter how many times things have been proven over and over again. People want to buy when prices are high because that's when they hear about their friends making a lot of money, which is to some people the most motivating factor there is. So let's talk about the model itself. First of all, what are the factors that you utilize, and how did you decipher those factors as opposed to the myriad of other data points that are available out there?
There's 5 key indicators that I identified out of a universe size of, I think I identified 25 back before, that I mentioned in my book. And so what I did is, being that nobody knew the real estate cycles better than me, because I've lived through them, and at the dinner table, I knew when things were good, because we were taking vacations, and when things were bad, we were moving into spec homes in Rancho Santa Fe. You know what I mean? That's what it takes to survive. So but I knew what the cycles were, even though, people talked about the cycles in the past, but nobody knew them like I did. I could identify them. I guess I have a real knack for that kind of thing. And so I looked at these key indicators, and I saw which ones were correlated with price movement in the market, the peaks and the valleys. And I identified 5 of them out of the 25, discarded the rest, because what you want indicators that are leading indicators of future trend changes that are highly correlated with price movement. That's the idea. That's the idea of market timing, to stay ahead of the curve, as they say. So the 5 key indicators are existing home sales, new home building permits, notice of defaults, foreclosure sales, and interest rates. And I found that, played around with the numbers, looked at them, and put them into a model and tweaked it a little bit. And that model was created almost 20 years ago based on the way I thought it would work best. And guess how many times I've tweaked it, Hunter, in the last 20 years?
Tell me.
0.
Yep. Makes sense.
It's interesting because as people that are looking to see things, all of a sudden, if the markets change and your system or your model doesn't, you just can't say, and just forget about that. A good model, a good timing system has to work through good markets and bad, and through periods of, all kinds of periods to prove itself. In fact, I wrote my book 15 years ago, and interestingly, the model has, when I first put the model together, it was based on back testing, right? Because I knew the cycles. And going forward, the model has proven to be more accurate than it was on back testing. So that's always a good sign, and I'm really proud of that.
Totally. Now, what are some of the years, I guess, that the market timing strategy led you to a really solid sell conclusion?
Well, it's all determined by the model, Hunter. It's all determined by the model. I have this in a model, and it requires, about 5 or 10% subjectivity and about 90% objectivity. Okay. So whatever the model says is what I do. And is that the question you're asking?
Yeah. So for example, what happened in 2007 and 2008, I think a lot of people that were paying attention to the market, a lot of them started to exit in 2005 because that was when things were getting really, really unique. And then a lot of people make the argument that 2006 and 2007 was a result of the really interesting and unique lending programs that came into place. Where in that cycle did the market timing letter or your book and that cycle that you utilize, when in that period did the actual sell signal happen for your model?
Well, for San Diego County, I track 19 different major U.S. cities all across the country, 6 of which are in California. Are most of our listeners going to be from California or no?
Yeah, all over the country, but I'm particularly interested in California because it's a really wild market, and there's definitely a lot of listeners that are in Los Angeles as well. So yes.
Sure, because another thing, Hunter, is that as a market timer, California is the best state in the United States to market time markets because it's the most volatile. And that's what you want. If you want to get in and out of the market, and I'm not talking about day trading, folks, or that short-term trading. I'm talking about getting in and out of the market on a 4 to 8 year period. That's the kind of market timing because that's what the cycles are, and that's what you want to do. So that's the kind of period of time that I think we're looking at. And based on San Diego, my model gave me a sell signal. I think it was in September 2010, at the peak, 2005, in the mid 2005. And how accurate did that measure the peak of the market? According to the Case-Shiller, who tracks 20 major cities in the United States, one of which is San Diego, that was within about 1 or 2 months from the peak of the market. So that's how accurate from a timing standpoint, from San Diego standpoint, everybody, that after mid 2005, prices started going down. It lagged a little bit in Los Angeles and up in the Bay Area. They lagged behind about 6 to 9 months, depending. So you got to track the individual stats for each individual city, even though California, all major cities in California move up and down in the same direction with a super high correlation. So in other words, if the trend's down in Sacramento, you can pretty well be sure if it's not down in San Diego, it's going to be down in San Diego. So that's an interesting discovery I've made in the last 15 years since I wrote my book that I had no idea about before, because I hear people saying all markets are local, all markets are local. Okay, yes, I guess I kind of agree with that. But in San Diego, all the major markets go, rise together and fall degree with about a 95% correlation. So does that, negate that statement? I don't know. I kind of think maybe it does in some cases. So there's always exceptions to the rule.
Yeah, certainly. Looking at the model itself, when you're looking at the raw data, how do you convert that raw data into a timing indicator, whether it be a buy or sell indicator?
Right. Well, what I do is I treat each of the 5 data pieces that I follow individually. But what I do is on a month-to-month basis, I take a 12-month moving. First, I gather all the data I can. Let's say there's, I have, I guess close to 35, 40 years now. But I would put it all in a data sheet, all the past data. Then I would take a 12-month moving average of that data. And you know what a moving average is, right?
Yes.
Okay, good. Then of the moving average, you take that's the trend following aspect of what I do. Then of the 10-month moving average, you take a 12-month momentum reading of those 12-month moving average readings. And that's the momentum part of it. So, and then whatever that number spits out is whether that it's friendly or positive to price appreciation, or in the other case, negative and unfriendly to price appreciation. Then you put all the indicators together and voila, it spits out a number that tells you whether the major trend is up or whether the major trend is down. And you have a high degree of certainty based on 35 years of performance.
Okay, and so when the momentum is really high, is that a good time to be buying, or is that a time that you should already have bought when you're looking at the timing letter or timing
you
model?
Don't trade off momentum. You trade off the momentum readings. But anytime a momentum reading is positive for all 5 indicators combined, that means the trend is up. Prices are likely to go up. But the time as you can see during uptrends, the momentum reading on my charts, Hunter, stays above the zero line for long periods of time. For example, it gave a buy signal for San Diego. I think it was in mid 2010, which was, a very, very good signal. And it's been long. The momentum reading's been above zero or long the market for over 7 straight years now. So you don't trade off that. What you trade off of is when the momentum reading goes from below zero to above zero, which is a buy signal, or from above zero to below zero, which is a sell signal.
I see.
Am I getting too technical for you?
No, that's exactly what I wanted to clarify. And in fact, I've read your book, and I'm glad that we kind of clarified that for the listeners as well, because I'm familiar with the content, but that makes total sense. So essentially, the opportune time to buy is when the momentum shifts from negative to positive. That's when the bottom of the market is basically being
cheap,
coming out of, basically. Right. So like 2010.
Low, that's when prices are low and future price appreciation is likely.
Right. Okay. Perfect. And so that makes a lot of sense, and we'll probably get into, some of the bubble markets out there. I'm interested to hear your perspective on bubble markets, because there's obviously a lot of momentum. Yeah, go ahead.
First off, Hunter, I want to congratulate you on this level of knowledge you have, and I really appreciate talking with you like this, because I've done quite a few webinars and interviews and however you wish to call them, and this is the only one that's ever getting down like this into the real meat of the system, the mathematics and all that stuff, because that's what it really depends on. You have to be able to pull this off. It's not hard to do, but not everybody's real comfortable with mathematical equations and things like that. However, that's how you get an edge.
Sure. I agree completely. And I think that a lot of the value that you're bringing is that, you're compiling this data, you're putting it in a way that someone could read them without really being knowledgeable about how to actually construct that own model, which I think is really useful and really beneficial for a lot of investors, especially since
a lot of people. I've been in business now, writing my timing letter for 15 years. So over that period of time, your business gets better and better, because if you've got a good product and good information, Hunter, people start to trust you more and more. They trust it. Right?
Totally.
It's like I tell people, after 15 years, I'm an instant success.
Right. Yeah, exactly. With a really high level of correlation in terms of accurately predicting buy-sell signals as well.
That's the product. I've always said, if you want to stay in business, you got to have a good product.
Right. So let's talk about the bubble markets. There's a lot of markets over there that are extremely hot, meaning that the momentum is probably off the charts in terms of what you're looking at. But at the same time, I think that you would make the argument that they're quite overheated. So what are some of the markets that you're seeing that are in really massive bubble territories?
Well, massive bubble territory is the Bay Area. That is like so richly valued all the way across the board. I said it was massively bubbled, massively inflated when the median home price in San Francisco reached 1.3. I didn't say sell it yet. I just said, boys and girls, this next downturn is going to be really ugly. And and since then, of course, it's gone up to 1.5. So, I mean, bubbles can keep inflating and inflating and inflating. And, and the other bubble markets that I see in the country right now are, I think Denver's a bubble market. I think Portland's a bubble market. And I think Seattle's a bubble market. I think Dallas is a bubble market. And especially Dallas and Denver, because those are in the Midwestern part of the United States. And if you were to research price appreciation like I do, or just do some studies on your own, you find where all the price appreciation historically comes from is along the coast, Hunter. Midwest is like slow and plodding along, no big booms, no big busts, blah, blah, blah. Well, those things have gone, the spike in housing prices in Denver and Seattle, Denver, Dallas, and Seattle, those spikes are huge. Just huge, and I can see that they've become overvalued relative to where they should be, relative to their long-term history, and Portland's just a surprise too. But you see those things that you see markets like that. The California is, aside from the Bay Area, I don't think there's any what you'd classify as bubble markets. They're richly priced, of course, but they're still not bubble markets. And the trend for everything in California is still up. I say people stay invested. There's no reason, unless you need the money for something right now, there's no reason to sell a piece of investment property right now. No reason, because the trend is up. Unless you have some great opportunity, of course, to buy something, that'll turn out to be a great investment, but that normally implies great risk too.
Sure.
Put all the money into Bitcoins or something, right?
Right. So in relation to the conversation about the bubble markets, then, are any of these markets actually issuing sell signals, or is this preliminary in terms of this isn't a market that you should be purchasing in actively?
Trend is still up across the board, Hunter. So no sell signals. And the question you raise is really a good one. Should you jump into the market right now? What I consider to be the best response to a question like that, and that's a very good question, is this. Depending on which market you're in, if you were to jump in the Bay Area right now, nobody knows how high prices are going to go. Nobody. They're going to go up here to here to here. I see them, priced out at this before it tops out. That's just pure friggin' guesswork. So you don't know. But the Bay Area, let's use the Bay Area as an example, that, you could jump in right now there and buy a home in the city for $1.5 million, the average home, and maybe it'll go to $2 million. But what you have to do is that you got to be watching these signals, real carefully, because the move from 1.5 to 2 million is going to be a lot less than the move from 2 million to wherever it hits bottom. You know what I mean? Mm-hmm. So what you should be willing to sell at this point in time. Of course, I'm always the one that advocates. My basic investment philosophy is this: you win by don't losing. In my view, especially in California in particular, because the market is so volatile, is that you should buy for price appreciation only. So in other words, you're buying when it's low, because the indicators, my momentum indicator is going to turn from minus zero to above zero. You're going to buy then, and you're just going to hang on until that momentum indicator falls below the zero line again, at which point you're going to sell, and you're going to pay your taxes for making that huge gain you just made, and you're going to have your cash available. And so then you can either keep it in cash, which it probably isn't the best choice, for most people, but you can put it in alternative real estate investments, even something like, hard money trust deeds, low loan to value, that'll bring you 9 or 10% during the next correction. When it comes, until it's time to buy low again, you can double your money doing that.
Yep.
So in other words, I'm all for I've never met a person in my life that ever lost money buying low and selling high. Based on my 70 years on this planet, I just turned 70 this year.
Congratulations.
Thank you. I got 30 more to go. I've met lots of people over the years that have lost money in real estate buying for other reasons. Cash flow. Cash flow. Or most of them buy too late. You nailed it with your comment, that market psychology is a far bigger factor than most people realize, and that's what sabotages most people's results. It's amazing to me. Everybody loves buying high. Nobody loves buying low, but everybody loves buying it when it's high, right?
Right.
Is that the way Warren Buffett gets rich? No. So what you got to do is you just got to, and that's why to overrule your emotions, that's where you need a system. You need a system of some kind that gives you an edge, whether it's in the stock market or real estate. Like my timing model is a system, and it gives you a significant edge. So you just play that edge over time, and you keep playing that edge, and you will outperform the people by a wide margin that don't use that edge. That's my investment philosophy. So it's back. You win by not losing. You're only invested in California real estate when prices are going up. When the signal is to get out and go down, you sell. You go to cash and you look at other investment opportunities. And if you like real estate, that's fine. Go second money, hard money loans. Or if you like real estate, go REIT. You can make a lot of money in REITs with the right kind of system. So the key to success is avoiding losses.
Sure.
Like my dear old dad used to say, the secret of success, kid, is avoiding disaster. And you never know where these markets are going to take you, either on the upside or the downside. Hunter, you don't know. For example, right now in California, let's compare two cities. I wrote about this in my last letter. San Diego. Well, let's just use the Bay Area and Bakersfield. Since the peak of the market in 2006, San Francisco housing market is up 35%. In other words, above break even. Los Angeles and San Diego are at break even. Bakersfield. There's almost 400,000 people out there, so it's not a little, hick town out in the desert. Bakersfield property values are still 38% below break even. So anybody that was counting on that kind of money, it wasn't, for retirement, to send their kids to college or something like 38% below. And who would have thought that could have happened in Bakersfield? Nobody, you wouldn't think in California that could happen anywhere, but it did happen. And so what you have to be aware of those kind of huge risks that are always in the market, Hunter, and you don't know whether they're going to come. But the key to me is that, look, when housing prices are peaking out, sell it. Don't take that risk, because who knows? It may be the Bay Area next, right? Maybe social media. Maybe they find out there's study after study after study, and they find out social media results in brain damage. Do you think that would have an impact on the Bay Area economy?
Right. Yeah, that's a good point. I think you brought up several points there that are just really interesting. And also I think that Vegas, I don't think is back to break even at all yet, despite the fact that I believe that they experienced a 70+% appreciation since the bottom.
Excellent point. Excellent point. Because they're 20% below break even. So if you're one of those people that was told, anytime you own real estate, for 10 years or more, you're going to be happy. If it cash flows, you can't lose, blah, blah, blah. That's the way that the industry touts real estate. They don't want to talk about the risks, only the positives. Well, you're 20% below break even in Vegas after a 70% upside move. That's tremendous. A lot of people, these are people's financial futures that you're messing with here. That you're playing with here. We're talking specifically to investors here. So whether it's stocks or real estate or whatever, what you want to do is when it's time to retire, you want to have, you want to grow your money and protect it, both. So you have to protect it from loss. And that's why you have to do that. Most people fail, they focus on returns and they don't focus far enough on risk management, Hunter. Everybody's got dollar signs in their eyes. That's human nature. Okay, we're the real long-term successful guys, the most successful guys. They're focusing on the other direction. They're focusing first on risk management and knowing that if they can avoid big losses and they have a good system, that the future rewards will take care of themselves, which they do. but that those are the superior investors that do that over and over long periods of time. And, they make higher compound returns on their money than other people, but, they've all got some kind of edge. They don't buy when prices are high. And that's for sure.
Right. Well, so just going back to kind of the model itself, are there any times or any ways that the model can give you misleading signs, whether it be one indicator or several, anything that you've experienced that kind of made that point?
Yes. And that market was, and that's where the 20 to 25% subjectivity / experience comes in mind, where the market I have the most trouble with timing in California is San Francisco. It's more volatile. It's the highest priced and it's the most volatile. So what I had to understand, there was some point back in time, maybe, 10 years ago, 5 years ago, I can't remember, but I did remember writing about it in my timing letter, when everything in California, all my major cities, the state of California, the 5 major markets I followed were all trending up. That, there was no reason to sell, but San Francisco, for some reason up there, gave a sell signal. And I chose to ignore it because I know everything in California goes up and down in sync. And I said, you know what? I know the beast. I know the Bay Area is a tough one to market time as accurately as, let's say, Los Angeles or San Diego. So I ignored the signal and I was right. And I had a high probability of being right, like maybe 80%. And those are the kind of odds, so you got to know when to break the rules. Everything's not completely cut and dried in this world. And only about 70 to 80% of it.
As it turns out.
Turns out, right.
So do you pay attention to consumer sentiment and market sentiment? For example, there's frequently an inverse correlation to the amount of people that think that real estate's going to go up with real estate actually going up, right? And so do you pay attention to things like that? Obviously, it's not factored into the model, but do you watch things like that?
When I read about it, when it comes across my desk, I recall maybe a year ago I wrote a blog post about it, about Pew, P-E-W. They do a lot of polls, and they polled California, California individuals, real estate investors, and they say, what percent of you think that housing prices are going to be higher next year, next year, right? And they had something like 80, 85%, 90%, somewhere up in that range. Real high percent thought things were going up. And then you look back at what the reading was back at the peak of the market in 05, 06, and it's the same high reading. And I find that fascinating. Now, that doesn't mean that prices still can't go lower, but from a sentiment standpoint that, everybody expects prices to go higher. And so, and that's what of course fuels the continued up move in prices, is that expectation. However, at some point that's going to change. And that's definitely a sentiment indicator, Hunter.
Okay. A question about California specifically. Historically speaking, California as a whole has peaked out at around 17% affordability, which means that about only 17% can afford a median home with 25 or 30% down, depending on how they calculate it. We are pretty far away from that right now. I think California is currently hovering around 30% and has been for quite some time. Do you think that, well, first of all, do you follow affordability? And if so, do you think that affordability is going to get down near that 17% range before there's a pullback? Or do you think that it'll probably happen before that during this cycle?
I follow national affordability, as published by National Association of Realtors, but not California. Because even though it's had using affordability as an indicator that you mentioned, has had some fairly accurate calls in the past. Within a year or two of the top or bottom, they're not nearly as precise as the monthly indicators that I use. But just give them respect. And I've seen that. However, in California, for example, in the two prior booms and busts prior to the bubble boom and bust, California housing peaked out at a 17% affordability rating, as you mentioned. During the bubble, it wasn't 17%. It peaked out. When prices turned, it got all the way down to 10 or 11, Hunter. So, I mean, that's a big miss there. And now, like you said, they're in the 30 range, and we'll see how this one turns out. But that you don't need to use that as an indicator. The only value that affordability indicator has, either for California, in my mind, or the main value, or nationally, is that when affordability is decreasing, that's positive for housing prices. When it's increasing, that's a negative. So that's something else that I'm aware of. I mean, even though I rely, super heavy on my 5 key indicators, an indicator like that is always in the back of my mind, because I know it has a high correlation with price movement as well. However, it's not as sensitive to getting in and out of the market on a fast enough basis, right? I want to be out of the market at or near the top. I don't want to be out of the market 6 to 12 months after the top.
Yeah, definitely. Because things can, especially in California, things can really, really get nasty quickly.
Yeah, I mean, look, and if you're good at what you do, and I work hard at being good at what I do, you want to increase your edge, all the time, to be better and better and better. And, that's what that's what a good business is all about. You have a good product. So you have to stay up on those things. But it's a fascinating subject, that's for sure.
Sure. Do you think that lending standards will loosen substantially as we go towards, moving later and later in the cycle, as sometimes they tend to do? Or what are your thoughts on the current state of the capital markets in general, in terms of the access to debt, particularly for real estate investments?
Are we talking about, you want to talk about mortgage borrowing first? From a mortgage borrowing standpoint, little by little, I keep hearing stories where you can borrow the down payment. Hey, that's not an easy thing to do. Or, you can get a 3%, down Freddie Fannie loan, with a low score, stuff like that. And in some cases, some real crazy cases, there's some zero money down programs. But, those aren't as readily available, and they're more costly. So I don't know. I don't think lending is going to get real easy again, because, the next bust is going to be for a different reason that we don't know yet, right?
Yeah, exactly.
I've heard people comment before, Hunter, to me, and they said, I don't think housing prices are going to go down because, the lending the lending criteria, never got as easy as it was during the boom. And I said, yeah, that's probably right. So it's most likely won't be for that reason. It's going to be for some other reason that you only know with 20/20 hindsight. I mean, there's a lot of risks out there in the marketplace, that's for sure. It just doesn't have to be from lending. I mean, California's gone through boom and bust cycles, for the last, 40 years, without, easy to get financing. So it's kind of like you don't know. You're going to be able to tell when it happens, but why it happens, the one event, the one thing that starts to trigger the turning point from up to down, you really don't know what that's going to be. And in most instances, you'd be well better served just spending time following key indicators than you would try to figure that out.
Got it. Sure. And I'm sure you get that question often, as far as, what's going to cause the next recession, et cetera. And to your point, there's so many different variables. It's very challenging. There can be some kind of terrorist attack. There can be some kind of flu endemic or something like that. Is there anything that's on your sights in terms of something that you're watching? Or is it, like you said, just too overwhelming? You focus on the key indicators and kind of move on with your day?
The things I'm watching, my friend, I'm watching, way bigger things than a terrorist attack. I think we're facing a future economic storm because of entitlements. And, the pensions in particular, medical, for example, we're going broke because of rising medical costs. And I identified this, from a macroeconomic standpoint about 5 years ago, because medical costs for about the last 10 years have been going up at an average rate of like between 8 and 10%, Hunter. I mean, have incomes gone up 8 and 10%? Like 30 years ago, the average American used to spend 5% of his income on healthcare. Today, it's close to 20. That's busting them. That's busting people. They don't have any money. That's why everybody's broke. They're spending it all on healthcare. Then when you combine that with the fact that, that you got these pensions coming due that are severely underfunded, both on the political both on the public and the private side, you wonder, okay, as these government workers retire, as you know, who's going to pay their pensions? And even in big corporations, you know, they're underfunded, not as much as the federal government, but they're still underfunded by about 30%. And where's this money going to come from? I mean, and, you know, because people have to be paid. And my theory on this, on macro thinking, is, yeah, everybody's going to get paid, but we're going to see massive inflation in the country. And it probably, you know, I would say it's less than 5 years off. So you have to be ready for that risk. And how's real estate going to respond to that risk? You know, like real estate is a good inflation hedge, right? Yeah, sometimes it's not. So in other words, there's lots of moving parts and they're all interacting with each other. And that's why you have to look at each individual asset class and, you know, follow trends in those individual asset classes and let the market tell you whether you should be in or out, because it's not what you think. It's what the, you know, collective actions of millions think, right? And that's the trend you want to be with.
Let's change topics briefly for a second to talk about commercial real estate, because I know a lot of listeners invest in commercial, and I also invest in commercial. First of all, how do multifamily and single family, or commercial real estate in general, and single family track along with each other, and how well do those work with your timing model?
Apartments track with my timing model because it's residential. That, you know, I track residential real estate, and that includes multifamily residential.
Okay.
I do not include other kinds of real estate because there's not enough transactions in it. I mean, in commercial real estate to get a feel for the real trend and key indicator. It's much, you know, highly illiquid market. But I do know, I mean, for example, I do know they're boom and bust. You know, you look at a chart and tell me things aren't like super high right now. During the last bust, you know, like nationally in the United States, housing prices peaked in 2006. Commercial prices peaked in 2007, a year later. Right now, I just saw a chart, like for the first time, that uses a momentum indicator with respect to price. For the first time in a long time, I mean, I believe since the uptrend began, and that was back like in 2012 or so, I forgot when it turned up, but the first time in 5 years, the momentum indicator for price has turned down. And otherwise, commercial real estate, not including apartments, has peaked out. I'd say there's probably a real good likelihood of that.
Okay, yeah, I appreciate you sharing your perspective on that. So here, you know, after having this conversation, it's always interesting because we haven't actually talked about your own investing strategy. So are you currently investing in real estate? And if so, what strategies are you implementing for investing right now?
Hunter, I just turned 70 years old. I have a good life. I have a business I love. I go to the gym every day at 9:30, work out for an hour, hour and a half, come back, work on my business some more, go to the beach, take a run, 1 to 2 miles, come home and work for the rest of the day. Only I don't have time to be a successful day-to-day real estate investor. I don't have time to do that. Like a flipper or something. Could I do that? Absolutely. I mean, I could compete with these guys and I'd be terrific at it. That's a full-time job. And that kind of job conflicts with it cuts into my gym time, to be honest with you. And that's more important to me. My health is more important than making a ton of money. So, but I'll tell you what I am going to do. In my Roth IRA, at the next market cycle bottom, I'm going to buy a house. I'm going to buy a house in it, fixer, buy it cheap, you know, because I know when to buy it, the right kind of property to buy it, and probably hold it, you know, 4 to 6 years until the up cycle's over. And I bet you I'll make, based on the improvements and things I'll make, I bet you I'll make 200 to 300% plus price appreciation and cash flow. I bet you I'll make 200 to 300% of my money in 4 to 6 years, and it'll all come out tax free. So I'm real strategic like that. I'm not going to go out there and looking for deals. That's hard work. Or I'm not going to build. I love building too. I'm a builder. I built for 10 years. I built 8 and 16-year apartment houses in San Diego. And I was, you know, in the mid 80s. And, you know, I did that for like 5, 6 years. I was making $100,000 profit on each unit. And I did that, you know, so $200,000 a year. And that was back in the 85. I mean, that was a lot of money back then. And that'd probably be like, you know, 400 or 500,000 today. So I mean, but it's real time consuming because you got to be on the job to be good at whatever you want to do. And if I don't do anything unless I'm going to be really good at it, if I'm going to be a flipper or go out and buy land and build a home, I'm on that job at 7 a.m. when everybody shows up, and I stay on that job and keep that job running smoothly, checking out the specs. If I want to make any changes, I see them happening ahead of time, so they don't cost me a lot. But it's real time consuming to do that, and I don't want to spend the time to do that anymore. Plus, traffic sucks around here. You can't even go anywhere, right, without getting in a traffic jam. I've got enough reasons.
Yeah, no, that's perfect. So we're going to close up in a second, but before you go, I wanted to kind of mention a quick story that happened. So I mentioned earlier that I read your book. That was I kind of brushed that under the rug, but the reality is that was one of the first and one of the most influential real estate books that I had read. This is in around 2010, and I had dedicated 100% full time into real estate. And that was, I saw you speak, bought your book, read your book, and then I think about 6 months later, you were speaking in San Diego, and I went down there. And so now the listeners have heard, kind of your perspective on a lot of stuff, which has been not negative in terms of life perspective, but negative in terms of prices. The motto in the middle of your speech, you said, rule number 1, survive. And this guy on the front row who was sitting there quietly goes, good, and opens up his notebook and starts scribbling like that was like all he needed to get from the whole speech, which is pretty funny. So anyway, it was awesome at the time. And, I still remember that stuff back then. So again, Robert, I can't thank you enough. I really appreciate you coming on the program. Real quick, do you want to just leave your information for investors to either get in touch with you or find your website and find some of your information?
Oh, sure. For those of you that find this conversation interesting, you can go to my website, which is realestatetiming.com. Realestatetiming.com. No dashes or dots or anything. Real easy to find. I put up a free blog post about every month or so, sometimes a little more. But you can buy my book there. That's $35, Timing the Real Estate Market. You can subscribe to my timing letter. And you can just read some of my past blogs and read some of the stories I have on there, and you'll learn a lot about my investment philosophy, which is, first off, survive. Don't lose money. I mean, because disasters are commonplace in this world, and so that's the first rule. But if you like what you see, you can buy my book or subscribe to my letter, and I think it would, if you find it interesting and you're that kind of investor, I think it'll be very valuable to you.
Awesome. Robert, thanks again for coming on.
My pleasure, Hunter. Thank you very much for inviting me.
For all the listeners out there, thanks again for taking the time to check out this episode. If you'd like to get in touch with Robert, like to follow his timing letter or read his book, feel free to follow those links in the show notes page. I can tell you that, looking at all that data, compiling it, putting into a 12-month moving average, doing all that stuff, if you want to do that, you can. But you can also just subscribe to his newsletter, and he will outline it very clearly for you. Every single newsletter that he puts out is full of information, and you'll get a really good sense of the market in terms of timing and in terms of where the opportunity may be coming up in the future. That's all for now. Thanks again.